A ceasefire extension in the Middle East has done little to tamp down global uncertainty. But according to our guest today, investors need to be thinking beyond headline volatility. Joining us now to discuss is Christian Medeiros, VP, Director, and Portfolio Manager for Asset Allocation with TD Asset Management. Christian, great to have you back in the program.
Great to be back.
All right, so we have the situation now where we're not exactly sure where we're headed. We haven't been really sure where we're headed for several weeks when it comes to the Middle East. How do you start thinking about that headline volatility? Because we had been whipsawed.
Yeah, investors have been buffeted with headlines on either side. Ceasefire, no ceasefire, escalation, de-escalation. I think the important thing for investors is to take a step back. And as we've talked about before on this program, when you have a geopolitical or exogenous shock, it's to think about how does that shock transmit through the real economy, then how does that affect different asset classes? And is it really something that necessitates a change in your portfolio? And the other thing I'd also point out too is building a portfolio construction that does well regardless of regime, that you have things in the portfolio that will work in periods of these shocks so that you do have a smoother journey and that your P&L and your emotions are not swinging around with headlines and that you're more comfortable managing through these periods of time.
All right, I think we can break this down in terms of asset allocation in 3 ways you have for us to keep in mind to stay cool during times of global turmoil. Focus on diversification is the first one.
Yeah, so focus on diversification. What we mean here is different asset classes work in different regimes. So in periods of high supply shocks and inflation uncertainty, we've seen a bunch of those since 2020. We've seen supply chain disruptions back then from the pandemic. In 2022, we saw the Russia-Ukraine war and rising inflation. And now we see disruptions in the Middle East with the closure of the Strait of Hormuz. In periods of supply chain disruption and inflation uncertainty, asset classes like commodities can do quite well. And some real assets like infrastructure and real estate can provide steady income with inflation protection. In other periods where we have strong economic growth, relatively benign outlook, equities provide steady compounding and returns. And on the other hand, in periods of growth drawdowns or growth concerns, fixed income can provide a buffer to the portfolio. So using a whole bunch of asset classes within your portfolio provides you the ability to ride through these periods of uncertainty and gives you a smoother path for your returns.
Do some investors overlook the fact sometimes, so they hear about diversification in a portfolio, but that's going to mean sometimes one part of your portfolio is working, another part isn't working. That's the whole point of the diversification. Do people overlook that sometimes?
Yeah, I think people overlook that because it's very easy in periods where one thing is working that you want to be all in on that one thing. But I think investors will note in periods like today where you have headlines on both sides hitting the tape every single day, if your portfolio is entirely trading on one headline versus the other, that's not diversification, and that's probably a risk that someone might not be comfortable taking. If your whole portfolio, your whole wealth is really riding on one outcome for a geopolitical event, that's not true diversification. So that's the benefit of having a broad mix of asset classes in your portfolio.
Great. The second point you have for us here is to actually look through, as human beings, we're emotional. We get emotional about geopolitical events. They sadden us, they worry us, but actually focus on what matters to the markets.
Yeah, first and foremost, it's a human tragedy. But from an investor point of view, when we think about the transmission mechanism, we have to think of whether that shock will flow through into the real economy. Will it hurt growth? Will it result in higher inflation? Will it then have policy implications? And then how does that matter for different asset classes? So for an asset class like equities, they're willing and they're pricing long-term cash flows many years into the future. Disruption in the periods of months to key commodities are not necessarily going to change the earnings outlook for equities over the long term. And so they're willing to look through short-term disruptions. But it will depend by sector and region. Regions that have been more affected, they're more dependent on energy imports. They've done worse off, such as parts of Europe, parts of Japan, parts of Asia. But areas of the market that are less dependent on energy imports, like US and Canada, have outperformed since the conflict. So you can kind of see how it transmits through equities, but equities are willing to look through if it's a short-term disruption. When we move to fixed income is going to be thinking about, is this a material change in inflation that will result in a policy divergence? So it's not just the first-order inflation, which is higher CPI, but does it result in broader second-order inflation that results in higher wages, higher services inflation that central banks wouldn't be able to look through and would result in us moving into a hiking cycle? As of now, they're willing to look through a shorter-term disruption from the energy shock, and so they're roughly on hold. We're not going into a regime of changing monetary policy yet. Then for commodities are trading on the balance of supply and demand for every specific commodity. It's more coincident. So there are disruptions in major pockets of the commodity market, and so they've been elevated and remain elevated despite the headline shifts that we're seeing. So you can kind of think of the headline, how it affects the economy, how it affects the different asset classes, and if it's not pushing us out of the regime, you can be comfortable in holding your positions going forward.
Right. Point number 3 you have for us is also one that's hard when we're being emotional human beings. Don't overreact, whether it's to the bullish side or to the bearish side.
Yeah, the most dangerous thing we can do is overreact on emotional headlines, because if you sell at the bottom, you'll miss out on the gains. And then if you get re-engaged at the highs, you're going to continue to chop yourself up. You can't overly react to the markets. And I think the antidote to that are the first 2 points, which is diversification. If you have something in the portfolio that's working at all times, it allows you to rebalance, it allows you to have a smoother return journey. It just keeps you more invested and it can tamper down the emotional reactions. The other one is the second point, which is thinking through the transmission mechanism. There's so many headlines that we see on every given day. There's so many geopolitical crises, but very rarely is it one that completely changes the investment climate in a way that would require and necessitate a portfolio change. So the most important thing is really knowing when to stay invested, knowing when we need to react to geopolitical headlines. And the bottom line is it's very rarely that it necessitates a portfolio redesign.
Now, we frame this discussion around obviously the news of the day and the news of the last several weeks, which is the conflict in the Middle East. We hope we can find a way forward with peace and that the ceasefire will hold. But once that passes, it's not like the whole world suddenly is at peace. There's going to be something else we're going to need to worry about. Do investors need to sort of take this as a lesson in everything you've just said here to think about long-term whatever is coming our way? We know how to deal with it?
Yeah, exactly. I think what we've been talking about in our asset allocation since 2020 is we've moved into a world where we have more common supply disruptions. We're moving into a world that's more multipolar and not entirely dominated by the United States. We're moving into a world where countries want to build defense. They want to have better control of their resources onshore. That's a very different world than the one we are used to from the 1990s and 2000s, where there's more globalization and more peace. And so a world like that is one where we're going to have potentially higher inflation, more volatile commodity prices, different geopolitical flashpoints. And a world like that is one that necessitates other asset classes that provide diversification. And so that's why we speak about commodities, real assets, while still maintaining the core exposures to fixed income and equities, but perhaps having more diversified allocation, not being all in on one country or one sector, but being broadly diversified, because different things are going to work at different times. And we think we'll switch between different periods of different inflation and growth dynamics as we go through this period. So it really does necessitate a more diversified portfolio, but also does necessitate having the confidence to be able to look through geopolitical headlines and think through how it really affects the economy, how it really affects the portfolio, and having the comfort and confidence in the process that you've chosen to be able to ride through those periods of shock and trust that the portfolio that you've built is well designed to last through those periods of upheaval.